Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
So there's a number of different valuation models that have the price of Bitcoin at between 111 and 150 this year, so within the next couple of weeks. And then the stock to flow model has Bitcoin at over 800K by the end of next year, at the end of 2025. But we are just starting to see just the implications of having a crypto administration, Congress, SEC, regulatory heads, and getting all that cleared up is having a huge impact on bringing these markets back.
Something like the Department of Government Efficiency, a sort of massive government reform effort, is desperately needed, right? It is something that is long overdue. There's an endless number of lists of things where the government performance is just not where it should be. But the approach that they're talking about taking is sort of so profoundly mismatched to the needs of what the government actually has that it's hard to see how this effort is going to be helpful.
Well, the inflation numbers definitely are something, if they're really out of whack, I think that's going to be something that people are going to look at, right? And then the Fed's going to decide, what to do, if they're going to do another 25 or not. Either way, it's not going to move the needle. The markets are trading up. The Trump trade is on.
We got 1 hour to go until the market closes, and we're taking a look at the major averages. It feels like we're playing a little bit of a waiting game. We've had a bunch of jobs data this week, but obviously the biggie is going to be tomorrow morning with the non-farm payrolls report. And so we've got stocks kind of fading into that here. The Dow off by 185 points right now, 0.4%. The S&P 500 down about 0.1%, but you can see a lot of fluctuations throughout the day. And the Nasdaq, little change as well. But again, a lot of volatility in kind of a narrow range today.
Yeah, not a ton of fireworks. You are, of course, hanging out right around near all-time highs,
Yes.
given the relentless move higher we have seen. I think, Julie, you're right. I think some of this wait and see. You do have key jobs data coming tomorrow. The narrative has been, from any number of economists we've spoken to and strategists, that the labor market, you get that kind of cooling, not crashing theme we've been hearing about. So you're waiting to see whether tomorrow reaffirms that theme, and of course what our Fed officials make of what they see tomorrow morning as well.
Yeah, and just taking a look at the bond market as well, not really any change that we've seen there today. If you look at the 5-day move, it's also very little changed here as people try to figure out what the Fed is going to do. Within the stock market today, some big moves on the sector level, both up and down. Materials down a lot, healthcare down, industrials down, but consumer discretionary higher. So that's kind of the split that's leading us. Also sparking our interest, some of the meme stocks, and that's because our old friend, Roaring Kitty, tweeted something today.
Yeah, back in the news.
And so, cryptic as usual, but you saw the move in GameStop after that tweet.
But really all the discussion. We've got to talk let's talk Bitcoin,
All right,
let's talk crypto.
Where's my crypto here? Here it is. Here are the cryptos today with Bitcoin moving up 1.8%. Pairing some of the advance here, it looks like we're actually down below 100,000 again, but still got up as high as 103,000 late last night, early into this morning.
I feel like we might have the perfect guest to elaborate on this very topic.
Guest, indeed. Bitcoin indeed topped 100,000 for the first time ever. The cryptocurrency on that record-breaking run since President-elect Donald Trump's victory. Joining us now, Michael Saylor, Executive Chairman of MicroStrategy. Of course, MicroStrategy now one of the largest Bitcoin holders with just over 402,000 of the coins. I don't know if you want to do a little dance, Michael, if you've got some champagne behind you, but obviously we've been talking to you for a while now, and you have been a staunch bull on Bitcoin. You put your money where your mouth is in terms of adding it to the balance sheet over there at MicroStrategy. I guess, now that we've gotten there, now what? What's next?
Every day for the past 4 years, I've said, buy Bitcoin, don't sell the Bitcoin. I'm going to be buying more Bitcoin. I'm going to be buying Bitcoin at the top forever. I joked with Dave Portnoy today. He said, I missed it at 10,000. I missed it at 20,000. I missed it at 100,000. I said, Dave, it's still less than $1 million a coin. You're getting a 90% discount from $1 million a coin. I'm sure that I will be buying Bitcoin at $1 million a coin, probably $1 billion a day of Bitcoin at $1 million a coin. And so I think it's a very simple idea. It's just keep buying Bitcoin with your spare capital. It's going to appreciate against the dollar forever.
So, Michael, so if I don't own Bitcoin, though, and I'm listening to this, your advice is buy here or no, wait for a pullback? And then when I do buy, Michael, your advice to folks who are listening about how to do that, what do they buy? You know, do they dollar cost average into Bitcoin? What's your advice?
I think you should think of Bitcoin as a long-term capital asset. So if you have money you don't need for 4 years, or even better yet, for 10 years, you put it into a portfolio. You might hold scarce desirable real estate. You might hold your favorite artwork. You might hold some portfolio of companies you're going to hold forever. I think a part of that is Bitcoin. So I say dollar cost average into Bitcoin every quarter, sweep some long-term savings into Bitcoin, expect to keep it there for a decade or longer, and don't get too worked up over the volatility in the near term.
Well, and Michael, you know, you kind of alluded to this, that you don't try and time the market here. You're just going to, the strategy through MicroStrategy is to just keep buying consistently, regularly, no matter what the price is.
Yeah, I mean, I look at it like Manhattan real estate, the year is 1650. And if you had a chance to buy it in every decade from 1650 to today, wouldn't you just keep buying it? If you didn't have to pay property tax and you could hold it, you would just keep accumulating it forever. There's never a bad time to buy it. There's a Sailor tracker. You can look at it. It just shows we bought at every price point, every quarter, at the highs, at the lows, at the mids. I bought it every week for the past 4 weeks in a size billion or more. I'm going to just keep buying it. And it's not that complicated. I expect that it'll be the most valuable thing in the world 100 years from now. So why wouldn't you just keep accumulating it?
Michael, we've talked a little bit about this before, so I want to just re-up the question before we move on. When you've likened it to Manhattan real estate, you collect rent on it, right? So at some point, do you somehow, monetize the Bitcoin that you hold in some way?
Yeah, well, imagine I gave you the chance to buy 40 city blocks of Manhattan real estate 100 years ago, but there were no buildings on it and there was no rent associated with it. But you knew it was going to be the greatest city in North America and you could buy it and hold it. It's, you would still do it, just like you might buy Alaska in 1867, even though there's no rent on it, because you think that over the next 100 years, someone else will find a way to take advantage of it. With Bitcoin, it's Cyber Manhattan. There's 8 billion people that have money. They're not going to live there, but they're going to put their money there because everybody has to park their money somewhere. And so you're just buying one block out of 21 million of all the capital in the world. It'll be the center of the digital economy. You may not know the applications, but there are applications. MicroStrategy makes a lot of money by holding that digital property. We're generating massive amounts of shareholder value from that. So you don't have to understand how we do it. You just need to hold your Bitcoin and let us drive the price up.
And Michael, obviously the move since the election has been powerful. Trump is moving back into the White House. He clearly positioned himself, as an ally of Bitcoin, an ally of crypto. What would you like to see, Michael, his priorities be now, his policy priorities?
Well, I mean, I think low regulation, low tax, pro-innovation policies give people, specifically with regard to digital assets, if we have a digital assets framework that supports digital commodities, digital securities, digital tokens, digital ABTs, digital currencies, digital NFTs, so that people can innovate in the United States of America and spread those assets everywhere in the world, I think that'll be good for the world and good for the United States.
Michael, I'm curious because we've talked to some of your peers in the crypto industry who have talked about maybe some of the friction at times that they have felt when they've been trying to buy crypto assets under the existing regime, under Gary Gensler at the SEC, for example. You guys have obviously accumulated an awful lot of Bitcoin at MicroStrategy. Has there ever been that kind of friction? Have you seen those regulatory obstacles to what you've been doing?
Well, I think Bitcoin is the one digital asset that has the most regulatory clarity in the world because there's general universal consensus that it's a digital commodity. The friction on Bitcoin has been slow approval of the ETFs, the inability to do cash create and redemption, the slow approval of the options market on the ETFs, and resistance to banks custodying and handling Bitcoin. So that's held back the asset class. I think that a favorable crypto regime will accelerate the development of Bitcoin. And I think on the digital asset side, right, just the lack of a digital assets framework for digital currencies and digital exchanges and digital tokens has put that industry in limbo. And I think we're looking for those things to be resolved with the incoming administration, and that should accelerate growth for everybody.
And Michael, this week on the show, we did speak to Senator Kirsten Gillibrand. And I asked her, Michael, specifically about this idea of a Bitcoin strategic reserve. Listen to her response here.
I don't know what the purpose of a Bitcoin central reserve is, and I haven't really seen the details of any idea about why you would do that and why that's important. I think it would have an obvious impact of supporting the Bitcoin industry, which in and of itself isn't good or bad. I just would want to know what the reason is.
All right, Michael, so the senator not sure about the reason for it. What do you say to that? What's your response?
Bitcoin is emerging as the world's reserve capital network. If you want to store your capital for the long term and you live in Africa or Russia or China or South America or even the US, your choice is local real estate or local stocks or Bitcoin. Well, people are realizing that Bitcoin is better than real estate. It's better than stocks. There's not a single company or real estate property in Africa that you would rather own for the long term than Bitcoin. So the very simple idea is buy 20 or 25% of the Bitcoin network on behalf of the US government, catalyze the development of that world reserve capital network, and then let all the Chinese and the Russians and the foreigners sell all their other assets and buy Bitcoin, and then the money flows into the United States. If you want to put a great twist on it, dump your gold, sell all the US gold, buy Bitcoin, then the trade is free because you could buy 5 million Bitcoin for the cost of the gold. You will demonetize the entire gold asset class, and our enemies hold gold in their banks, so their assets would go to zero. Our assets would go to $100 trillion, and we would control the world's reserve capital network as well as the world's reserve currency network.
As usual, you're painting a grand and vivid picture, Michael, with this kind of stuff. I know your long-term price targets are sort of almost infinite. Let's talk shorter term, and let's assume that the Bitcoin reserve doesn't happen, right? Let's assume that conditions continue as they are. Where do you see Bitcoin at the end of 2025?
You know, I don't chart it month by month, but I noticed that it's been a 60% ARR for the past 4 years and even before that point. And my model is generally that it will grow at 60% ARR, decelerating to 20% ARR over 21 years. So if you start to crank in 60%, then 58, then 56, then 54, and you put that on a scale, absent the cyclical volatility, you get to a forecast which makes sense.
Michael, quick question on that cyclical volatility, right? Because typically Bitcoin does move in these 4-year cycles, and there is a sharp pullback typically. Is that anywhere in sight, and what would be a potential catalyst for that?
I think as the asset grows and matures, the volatility decreases, and those the extremes of the drawdown decrease. The structure of the market determines the volatility, and so if you're going to forecast the structure of the market, you can't look backwards. It's like if you looked at a bicycle 4 years ago, and I show up with a motorcycle right now, it's a different set of physics. The market right now is driven by the ETFs, driven by the options market, driven by companies like MicroStrategy, driven by the global adoption. So I think what you'll see is you will still see volatility, but you won't see the extreme drawdowns of the last cycle. You'll see a more gentle volatility. It'll surge up, it'll come back, but I don't expect like we saw an 80% drawdown in the depth of the crypto winter from 66,000 to 16,000. In order for that to happen, you had to have a bunch of very poorly capitalized companies like FTX and Genesis and Celsius and BlockFi force liquidate. We don't have those kind of companies in the system now. The capital structures of the companies participating in the market today are much deeper, much more robust, and there's a lot more equity capital today. So you'll see a different dynamic. I think it'll be muted to the upside and the downside because of the options traders that are moderating the market.
Michael, great to see you. Thank you so much for joining us, especially today on seeing this milestone in Bitcoin. Appreciate it.
Yeah, thanks for having me.
We're just getting started here on Market Domination. Coming up, Doge is taking over Capitol Hill, not the cryptocurrency. We're talking about the Department of Governmental Efficiency. It's trying to take over Capitol Hill, at least. We're going to get an update from D.C. later in the hour. Elon Musk and Vivek Ramaswamy are meeting with lawmakers today in an effort to gain support for their cost-cutting initiative. Stick around, much more Market Domination still to come.
Stocks hitting a pause on the rally today as the November jobs report now looms. For more on the latest moves, let's welcome in Eric Friedman, U.S. Bank Asset Management Group Chief Investment Officer. Eric, it is good to see you. So your bottom line here, Eric, is you say, glass half full, right? Favor equities. You know, it's interesting, Eric. I at this point, I don't remember the last time I spoke to a strategist who wasn't glass half full and favorite equities. I mean, it is just bulled up across the board. I wonder whether, that's a source of concern at all for viewers who are listening right now.
Yeah, Josh, it's a great point. I mean, we certainly don't want to be on the same side of the boat as everybody else, but the setup, if you will, from both monetary policy as well as the earnings cycle, we think are positives. Clearly, fiscal is an open question, but this is still an environment where this is a market that has to be proven wrong, if you will. And if you look at what we've just come out of in terms of earnings, it's been both top line and bottom line. Last thing I'll say is this. The swing factor we think it's really out there is what happens with the consumer. There's going to be obviously a lot of activity and chatter heading into the retail sales prints of the holiday season. What's going to be very important is what do consumers feel like in the first quarter of next year. So we're still glass half full, not just in stocks. We also think that there's an opportunity in credit, not corporate credit, but really more structured credit, which is, again, a mouthful. But we still think this is a time to add income and add risk to portfolios until proven otherwise.
Eric, on the consumer, what kind of tea leaves are you looking at that's helping you, kind of feel that glass half full feeling about the consumer going into early 2025?
Yeah, Julie, I think the biggest thing is the marriage of top down and bottom up. What I mean by top down is not just survey data, like we'll get to get great information tomorrow with the non-farm payroll data, which of course has a huge standard error, so we can't be too focused on it. But the top-down macro data is always helpful to see just what are consumers thinking from a survey basis or just from jobless claims or the employment picture. But probably the most important variable we're paying attention to is bottoms-up corporate earnings. And so hearing from a wide swath of retailers as well as both, big box as well as e-commerce entities to understand where is that marginal dollar going. And what we're starting to see is that continued bifurcation between lower income and higher income consumers. That's been well documented. It's not new news. But what's most important is understanding through corporate outlooks, what is that middle income consumer doing post the holiday season? Lots of noise through the holiday season, but we think it's really more important to pay attention to corporate outlooks and going to investor days and listening to outlook calls. That to us is probably the most important variable, which is tough to do. Unfortunately, we have a big team to do it.
Eric, on the equity market, even bulls come on the show, and if you ask them what concerns them, they'll, some of them at least will say they don't really love what they see when it comes to valuations here. I know it's a bad timing tool, but I'm curious how you're thinking about it.
Yeah, I think it is, Josh, important to look at valuation, and the way we look at it is through a couple different lenses, but I do think that in this backdrop of falling front end of the curve activity, which we again still think will be the case, we do think that Chair Powell's comments yesterday in New York were certainly well measured. Some may say a touch hawkish, but we still think the bias is for the Fed and also other central banks beyond the Fed to keep lowering interest rates. That's obviously something that makes earnings more valuable. So that's kind of the first point that we'd make is that yes, we're seeing on sort of traditional PE basis or price to sales or the Shiller PE, yes, there are certainly metrics that look a little bit elevated. However, interest rates are coming down at the front of the curve, which makes earnings more valuable. I think the other thing to pay attention to is that dispersion across sectors, which has been more constructive. Last year, if you didn't own domestic tech, you didn't do very well in your portfolio. This year, there's been a lot of broad participation, which is a good thing. So in a way, having that backdrop of still improving earnings trends, really the growth rate expected for next year is too aspirational. In the context of lower interest rates, we think that's a good setup for risk assets, particularly domestic equity still.
What about the DC setup, the policy setup going into next year? Obviously, there has been a lot of attention on what can happen with taxes, what can happen with tariffs. How are you factoring all of that in?
Yeah, I think it's an important list to go through. We kind of center on three areas. One is deregulation. The second would be taxes, and the third would be tariffs and trade policy. So we think deregulation, as a general statement, that's bullish for risk assets. We again understand that and I think it's a great segment you'll have on later about what the Department of Government Efficiency can actually do. There's a lot of things that have to still go through Congress. And again, our Washington team is really focused on the actual output that can be gained. But net, we think this is still an overall positive backdrop with deregulation and those deregulatory policies coming through. The second is on taxes. Again, I think there's a lot of expectation from the market, at least, and the immediacy of the Republican sweep, that there would be a quick resolution to the TGCA. We think that's probably going to be a little bit, distant in sometime later next year as opposed to the front end. So tax policy, investors should probably be a little more patient on and expecting that'll be an early congressional agenda item. I think the last piece is on trade and tariffs. And again, we think about this in terms of what's going to happen with China will be very different from what happens with the rest of the world. Also, to really point out that while everybody is very focused about how the U.S. acts, there's two parties in a negotiation. Of course, there's a reaction function from those other countries as well. So we do think that on balance, if you put all those things on the scale, that the policy set will be more earnings and equity friendly. But we have to, again, be somewhat reactive to what the news flow looks like. And again, most of that news flow will happen more in January and early Feb as opposed to right now. So again, we're still glass half full, still of the mindset that most policies will be pro-growth. But again, we'll certainly have some more details as we get deeper into the administration's inauguration in January.
Eric, always great to see you and have you on the show. Thanks for joining us.
Thanks for having me. Take care.
Coming up, shares of Synopsys lower today on the back of their latest earnings report. We're going to be joined by the company's CEO on the other side to break down the quarter. Stick around. Much more market domination still to come.
Now, time for some of today's top trending tickers. You can scan the QR code below to check out the best, worst, and most viewed stocks of the session on Yahoo Finance's trending tickers page. First up, a look at shares of Uber and Lyft as Alphabet-owned Waymo says it's expanding to a new city, Miami. The company aims to have the robotaxi service available to riders in 2026. We know now it is in places like Los Angeles. Now, you can't trade Waymo directly, of course. It's owned by Alphabet, but you can see the effect in its potential competitors that aren't even actual competitors right now.
Yeah, it's interesting because I know some analysts argue that, at least with Uber, and these are folks who have buys on that name, they actually consider Uber to be a winner long-term in the AV arms race because they think AV companies long-term are going to want to partner with Dara Khosrowshahi's company.
Right.
They're going to like the scale, they're going to like the brand. We'll see.
So we'll see, but investors right now are selling.
All right, turning to shares of another name here, Brown-Forman, the Jack Daniels maker, of course, topping second quarter estimates, reaffirming its full year growth outlook. Biggest intraday jump I was reading here in 4 years. Among other brands, Jack Daniels forecasts a return to growth this fiscal year. CEO saying we continue to expect our performance to accelerate through the second half of the year, and investors like the sound of that.
Yeah, big reassuring report here. The shares are down about 20% year to date, even including today's gains. And people have not been drinking as much whiskey. Brown liquor's been, I know you're doing your part, Josh, but
sure am.
yeah,
but that was part of the
in decline, right?
Part of the I know there's some on the street who cover the name were saying part of what you saw here was maybe kind of a sigh of relief that okay, American whiskey isn't in total free fall.
Right, exactly. Bill Chappell over at Truist making some comments like that. So that seems to be what's going on here.
Good news for the brown liquor.
Yes, indeed. All right. On Wednesday, chip design software firm Synopsys reported its fourth quarter earnings. And while the company did beat on earnings and revenue, shares are sliding after the forecast for fiscal 2025 revenue came in below Wall Street expectations. There was a slump in China sales as the U.S. tightens controls on what chip technology can be sold to that country. Joining us more to drill down more into this and talk more about the outlook is Sassine Ghazi, Synopsys CEO, who is back with us. Sassine, it's good to see you here. Obviously, there is a lot going on in your world in terms of the expansion of the demand for AI, your role in that. But, it doesn't sound like it's going to be up and to the right in a smooth and straight line for almost anyone. So talk us through what you are seeing currently and what you expect in 2025.
Hey, Julie, good to be here. Yeah, if you look at Synopsys' performance over the last 5 years, it has definitely been up to the right with a 15% CAGR growth during that period. We doubled the size of the company during that period due to an AI inflection point and significant investments by our customers to build silicon for the data center to satisfy that opportunity.
So, seeing some analysts who cover the company, and I want to get your thoughts on that. They looked over your the report in the end markets, and they said, Sassine's company there, AI data center seems strong, but they said, slowing PC, smartphone, auto demand. Walk us through what you're seeing.
So I like to describe it as we sell and operate in a tale of two markets. There is the AI infrastructure, and every company that is building semiconductor or any solutions for the AI infrastructure is booming, and we're doing fantastic with that boom. Then there is the other cohort, which is the rest of the semiconductor industry that's selling to mobile, to PC, industrial, automotive, that they're at a different point in time when it comes to their recovery. Some of them, they're still at the bottom. They have not turned. And other, they're trying to bring in an AI refresh cycle into their product, like AI on PC or AI on mobile, which is, again, a good opportunity, but is definitely behind the AI infrastructure investment and build out.
Sassine, let's talk about China a little bit, because there are two tracks of what's going on there as well, right? First of all, you have the macroeconomic backdrop there, which has not been improving as quickly as many investors wanted it to. And then, of course, there's the political backdrop and the export controls that already exist and the threat that there may potentially be more. So how are you managing around that, and what do you expect for China?
So China is absolutely, from a growth point of view, has been decelerating. If I look at our business 3+ years ago, the number of startups, the money that was being injected in the market was significant. That has changed over the last couple of years. Our growth in China used to be in the mid-20s. Over the last couple of years, it's been at around the corporate average, and we anticipate that to continue right around at or slightly below or slightly above. Now, so that's the one factor in terms of the China economy. The other factor is the trade and restrictions between the US and China, which absolutely have an impact. Pretty much every quarter, we get new customers added to the entity list. That's revenue that disappears off our backlog, as well as technology restrictions. Even customers that they're not on the entity list, however, they cannot design competitive chip due to restrictions. And these factors do have an impact on our business in China.
Sassine, I saw some analysts commenting that Intel, a meaningful customer of yours, they pointed out, obviously that's a company in transition, parting ways with its CEO. How are you navigating that dynamic, Sassine?
So we have a fairly resilient business model. Our agreements are multi-year committed agreements, and that's the beauty of our business. We have about 70% of our business is ratable, and about 30% of it what we call upfront. Now, the upfront portion in general is lumpy, and the reason it's lumpy is based on our customer need on when to use that technology, in particular IP and hardware, based on their roadmap. With Intel is no different. We anticipate with Intel in the short to midterm, there will be no impact. However, that lumpiness, the same as we see with the rest of the portfolio, will apply to Intel.
Sassine, great to see you. Thank you so much for joining us.
Thank you, Julie. Take care.
Coming up, Doge is taking over Capitol Hill. We're getting an update from D.C. on the other side as Elon Musk and Vivek Ramaswamy are meeting with lawmakers today. Plus, we'll be joined by Skybridge founder Anthony Scaramucci to talk about what potential risks could lie ahead for Bitcoin after surpassing the $100,000 mark. Stick around, we've got more market domination still to come. Tesla moving higher today on the back of bullish comments from Bank of America Securities. That's after a visit by the analyst to the Austin Gigafactory. And lead analyst John Murphy writing in a note, the trip gave us increased confidence that Tesla is well positioned to grow in 2025 and beyond with its core EV business and launch of its robotaxi offering and longer-term profits from its investment in Optimus. Murphy reiterated his buy rating for Tesla, upped his price target to $400 from $350. You know, I was saying earlier, Josh, it's kind of interesting that Tesla's moving higher today, but Uber and Lyft are moving lower on that Waymo news because Tesla, of course, is developing autonomous vehicles.
And of course, remember, I mean, it seems like forever ago, but early October when Tesla had its big robotaxi launch, some investors in the street clearly saw that as underwhelming, and Uber and Lyft actually popped on that. Remember, we talked about
there
it.
are Waymos on the road already.
This call is interesting. Basically, the analyst goes down to Texas and gets the full tour, meets with IR, gets the tour, has a drive session, and leaves the analyst saying, I mean, obviously they like what they saw and heard because they talk about increased confidence in Tesla's growth, positioned to grow that core EV business, launch that robo-taxi service. So they reiterate the buy and do take their target up to 400.
Yeah, I also saw Optimus, I guess. In
Yes,
action.
robots.
The Tesla robot learning how to catch a tennis ball. I don't know then what the next use case is
Evolving.
for. If you want to play catch, if you're alone and you have no one to play catch with.
Sooner it'll do this job.
Get
Julie.
yourself
Who
a
knows?
robot.
Robots.
All right, speaking of Elon Musk, he and Vivek Ramaswamy bringing the vision for President-elect Trump's Department of Government Efficiency to Capitol Hill. The DOGE co-leaders discussing with lawmakers about the cost-cutting initiative. Here with more, Yahoo Finance's Ben Worschel, who is on the Hill. So what are you seeing? What are you hearing about what these guys are talking about?
It's the real circus here, Julie. It's so it's the long-awaited DOGE Day. The long-awaited DOGE Day here on Capitol Hill. Elon Musk and Vivek Ramaswamy are meeting right now with senators and House members on the Republican side, and this is kind of a cap of a whole series of meetings they've had today, all across Capitol Hill. One I would take note of is appropriators, who are actually the ones in charge of government spending, and so they kind of have to figure out exactly what DOGE is, how it fits in here in Washington. So it's the start of what's going to be a long process. A couple little anecdotes for you. Musk was kind of going between meetings today, and it comes as he's sort of still been coy about exactly what DOGE aims to do. What is the kind of overall goals? Is it about cost cutting? Is it about regulations cutting? All these things. At one point, a reporter yelled out, "What is DOGE?" to him. All he did was smile and keep walking. At another point, they asked, "Do you want Democrats involved?" And he said yes. So we have a little bit of that to go on, and there is some Democratic interest here. But this is the kind of first step of what's going to be a long process up to and through President Trump's inauguration, where what DOGE, this idea of DOGE from the campaign and from kind of Twitter or from X, kind of goes to a reality of here in Washington of what it could actually be.
All right, as you said, Ben, first step of a long process. We'll stick with it. Thank you.
Yeah. Thanks much.
Well, Bitcoin hitting a milestone, surpassing 100,000 for the first time. For more on what is next for the cryptocurrency, we're now bringing in Anthony Scaramucci, founder of Skybridge. Anthony, always great to see you and have you on the show. So Bitcoin does enjoy this big moment, 100,000. As a believer, Anthony, walk us through just this milestone, what you make of it, why is it important? And maybe also, Anthony, it feels like a good time to take a breath and tell viewers how you think about possible risks for Bitcoin ahead as well.
Well, listen, Bitcoin is a volatile asset, so it peaked at about 103,700. It's already backed off 5%. So Bitcoin is the type of asset I always tell people, if you're going to buy Bitcoin, you got to hold it for a 4-year period of time. Any rolling 4-year period, you do well. But in any given moment, you've had big drawdowns. And Bitcoin has drawn down. I think its most recent and most terrible drawdown was 82%. And so if you were interviewing me, Josh, in December of 2022, I was having a very rough time. I think Bitcoin was 16 or 17,000. And a lot of people thought that we had made a bad investment in Bitcoin. And so we were dunces 2 years ago, we're geniuses today. So I would just caution people not to put too much money into Bitcoin, in the sense that they've got to be careful about its volatility. Now, if you're somebody like me, I have a lot of my personal net worth in Bitcoin because I'm not looking at it and not tracking it day to day. But this milestone is important because I think it tells people that Bitcoin's probably ready now for prime time institutional investing. And frankly, this milestone should have happened 2+ years ago when the futures ETF was approved in November of 21. It would have been appropriate to have approved the cash or spot Bitcoin ETF right after that. But Gary Gensler decided not to do that. He went on to lose a lawsuit resulting in the success of the January BlackRock, Fidelity, and others Bitcoin ETF. But this should have happened a couple of years ago, frankly, but for the regulation.
Hey, Anthony, it's Julie here. We just talked earlier in the hour to Michael Saylor, who, as you know, is sitting pretty on top of a pretty substantial mountain of Bitcoin at this point. And we talked to him about those 4-year cycles as well. Another guy who watches crypto closely, Gautam Chugani over at Bernstein, is looking at potential 250,000 by the end of next year and looking at those 4-year cycles. But do you think that the cycles will be more muted? In other words, do you think we could see another 80% drawdown, or do you think those kinds of declines are in the past?
Well, first of all, Julie, it's good to see you. I've been humbled by life and markets, so I will tell you that anything is possible. I do think, however, that there's a floor of support for Bitcoin now. With the approval of these cash ETFs and with legions of Wall Street people out there selling the idea of having Bitcoin in your portfolio, I do think that there is a floor of support. That's not to say that there won't be aggressive corrections in Bitcoin. But if you believe, like I do, and Michael Saylor believes, that this is an asset class, it just isn't another investment story like a stock, but it's actually an asset class, then Bitcoin should trade to the market capitalization of gold, which is roughly 10x where Bitcoin is today. And so if you don't mind, I'll just quickly, I wrote a book with Michael called The Little Book of Bitcoin. It's out today.
That's what we call a shameless plug, Anthony.
A shameless plug.
We'll allow it.
All right, but Michael said something to me, that I think you'll enjoy. He said, you wrote a great book, and I'm willing to endorse it, but you are too small in your asset allocation recommendation. What do you mean, Michael? I'm telling people to own 2%. And of course, Michael has 100+% of his net worth in Bitcoin. And the point being is that if this is your best idea, and it clearly is my best idea, I probably don't have 50 other ideas like this. And so I do think people should own Bitcoin and have it in their portfolios.
Anthony, I also want to get your take. Trump's pick to lead the SEC, Paul Atkins, as a crypto investor, what do you think of that pick? Do you like it, Anthony?
Yeah, I do like it. I know Paul a long time. He's a libertarian by nature. There's a picture of him actually in 2016. He was up for the SEC commissionership back then. Just to remind people, I was on President Trump's presidential transition team 8 years ago, and we interviewed Paul and Jay Clayton and many others. He's a terrific person. Believe it or not, he's liked on the left and the right. So, of course, there are Gensler enthusiasts that hate Bitcoin. My former high school friend John Stark is one of those. He likes Paul Atkins. And so you've got pro-Bitcoiners and anti-Bitcoiners that like him. I think he's a very fair guy. And I think he'll do an amazing job for the president and for the country.
Yeah, indeed. We talked to Sheila Bair yesterday. We talked to Kirsten Gillibrand, both of them saying they like that Atkins pick, which was interesting. Do you think that once Donald Trump takes office again, things sort of immediately get better on a regulatory basis for the crypto industry? I mean, there's been all this complaining about so-called debanking or at least friction within the system by people who are in the business.
So that's a great question. Unfortunately, I have some education in Washington, and of course, I learned the hard way. I got myself fired after 11 days in the first Trump administration. Things happen way more slowly, and they happen in a way more complicated way. And so I would just caution people, if you think on January 20th, a switch is going to flip and everything's going to be better and roses for Bitcoin and the digital asset community, it's just not how Washington works. It will get better. They certainly, I think, will deal with what you're talking about, which is this choke point 2.0, where people have been unbanked. I think there's been some unfairness to that. I think that will get repaired. There'll be more positive clarity on legislation. You mentioned Senator Gillibrand. I'm one of her supporters. I'm also close to Senator Schumer. I think these guys want a bipartisan stablecoin bill and more clarity on how Bitcoin and other cryptocurrencies are regulated. And so I think that stuff will happen in this Congress, okay, over the next 2 years. So for me, I'm positive, but I don't think these things happen immediately, Julie, and I want to caution people about that.
And do you think that there's any risk that the pendulum goes too far in the pro-crypto direction, and that, you know, there's any risk of retail investors getting hurt by if there are too few, curbs put on the industry?
Well, I think it's an important point. I think the smart, common sense people want propitious and appropriate regulation. They don't want to be overregulated, and they certainly don't want to be underregulated. I think the real serious players in the industry that want to conform to the best practices want rules in place to screen out the bad actors. So I don't see the risk of that. You just mentioned Commissioner soon-to-be Atkins as an example. I think he's somebody that's very, very focused on that. So I don't think it will swing too far into the under-regulation. And again, if you bring CEOs on from the various crypto exchanges, the best actors are looking for best practices, some help in the regulation, meaning willing to offer some self-regulation, but they really just want clarity on the rules. And I think we'll get that without over-tipping.
Anthony, switching gears a bit here. Elon Musk, Vivek Ramaswamy on Capitol Hill today. The new Department of Government Efficiency, Anthony. I'm just curious to get your take on that, what you make of it. Do you think it's a worthwhile effort?
Listen, I've been around too long. I hate to be this cynical, but these things have never worked. I'm old enough to remember the Grace Commission under Ronald Reagan. They presented all these cost-cutting measures to the government. None of them went into place. I'm old enough to remember Simpson Bowles. That happened during the Obama administration. Those guys put together a very comprehensive bipartisan plan. They submitted it to Paul Ryan and President Obama. It ended up in a paper shredder. The Musk Ramaswamy situation, these are very smart, capable entrepreneurs. Elon Musk is arguably one of the most successful people in human history. And so I don't want to bet against these guys, but I know how Washington works, and I know how slow it is in the process of cutting things, and I know how many legal protections are in place for things like entitlements. You know, somebody suggested, I think this morning, that they were going to cut $119 billion of veterans' medical benefits. I think there would be a huge political uproar on that. I don't even know if it's necessarily legal. So could they get some things done on the margin? I'm hoping that they can do that. Can they cut $2 trillion from the federal budget? I don't think that they can do that, and I think we have to be realistic about it.
Anthony, we know that you campaigned against now President-elect Trump, right? What do you think is the biggest potential upside, particularly for investors, from his presidency, and what are you most worried about at this point?
Well, I did campaign against him. You know, I worked for him. I have an understanding of how he thinks, and I'm worried about the lack of predictability, and I'm worried about the process. As an example, he has not signed the ethics agreement yet for the transition. He hasn't received the federal money for the transition, and there's things like that that go on. You know, the fact that he's meeting with all these foreign leaders right now, I find astonishing, because way back in 2016, I was present when President-elect Trump met Shinzo Abe, then the Prime Minister of Japan, and President Obama called him and said, you know, this is sort of a Hatch Act violation. Could you not do this? And President Trump was compliant with that. But now I think he's met with at least 3 or 4 different leaders. And I think this sort of stress on the system and the stress on the traditions have me worried. He's got a guy named Kash Patel that's up for FBI director. He said he's going to come after people in the media. He just filed a personal lawsuit against Olivia Troy for, I guess, her First Amendment right to criticize him. And I think there's a danger in that. And I think if Kash Patel ends up as the FBI director and he actually goes out and starts prosecuting journalists for their free right to speak and their freedom of expression, I think it's a very dangerous time, and I think it puts a lot of stress on the economy and a lot of stress on the system. So there are things that they're willing to do that I think don't work in the United States, which is why, yes, I did campaign against.
Anthony, when you worked in the White House, were there certain things that you had to divest when you took that position? And do you think that that's going to happen with this incoming White House? Are they, are there going to be conflicts of interest in terms of the assets that are held?
Well, I was in the process of following those rules and divesting, but of course I got fired, so it became moot. I didn't have to divest, but I was actively in the process of going over what the ethics rules were with my attorneys and making sure that I was legally and ethically compliant. There were other people in the cabinet, other people in the White House that just ignored those rules. I don't even think they were punished for that, and I don't think there was a lot of retribution towards them for doing that. And again, we got to be very, very careful about this stuff. You don't want to overly mix the government with business. You don't want to turn the United States into the American oligarchy. And so, again, we have to be careful with these things. And if you're telling me people are going to enter the government and not follow the ethics rules or what the potential conflicts of interest are, I'm going to tell you there's going to be decisions made that are not dispassionate decisions. They're going to be linked to people's business interests. And that's not really fair to the American people. That's not what I think the American people would like to see in their public servants.
Anthony, always great to see you and have you on the show. Thank you so much for joining us.
Good to be here.
Appreciate it.
You have to teach me how to grow a beard, Josh. I got to learn.
Next time.
I got to
Next
learn.
time.
Okay?
It's easy, Anthony.
Yeah. I need tips. I need tips.
Thank you, sir. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. So let's start with the major averages here. We saw the Dow closing pretty much at the lows of the session, drifting lower throughout the day by a little more than 0.5%, about 248 points here. The S&P 500 off by about 0.2% after gyrating considerably throughout the day, as did the Nasdaq, which also finished it down about 0.2%. Small caps doing worse today. We've been watching that group closely. It's down 1%. And so just sort of a meh sort of day in the markets here. We've been getting a lot of economic data throughout the week, but tomorrow with non-farm payrolls, that's going to be the big one of the day, which maybe will give us some direction when it comes to people extrapolating what the Fed is going to do at its December meeting, whether or not it's going to cut. Because when we heard Jay Powell speak this week at a conference, well, we didn't get necessarily much direction one way or the other definitively from him. Jared's got a closer look at the action from this session. Hey, Jared.
Hey, Julie, that's right. We got quite a few catalysts this month, not just tomorrow. We got CPI next week, the Fed meeting, so the list goes on. But today we did see some underperformance from the Russell 2000, that's small caps, which you were just looking at. I want to show the VIX real quick, and I'll just throw a 3-month candlestick chart up here. And we were just coming off the lowest levels. Hard to see that little candle down there, but it's kind of a bottoming formation. Does the VIX rise from here? That could portend a little bit of weakness in equities, but I wouldn't expect anything great in the month of December. This is a time of year when we tend to see volatility contract, and notwithstanding what we're seeing, with a slightly higher VIX today, we're really not seeing that in the realized volatility, which is not implied volatility like the VIX. So aside from the volatility lessons here, consumer discretionary was the best performing sector today. It's been one of the best since the election, and you can see materials, that was leading the downside. That was down 1.37%. Industrials down over 1%. So is healthcare. So more losers than winners. And if we take a look at the NASDAQ 100, where we had a spectacular day for the mega caps yesterday, kind of a split day today. Tesla up 3%, while we're seeing Alphabet down 1%, and then Amazon and Microsoft, they are each up 1%. Josh.
Thank you, Jared. Markets closing lower to end the trading day. Joining us now is Jay Bowen, CEO, President, and CIO at Bowen, Haynes & Company. Jay, good to see you on set.
Good to be here.
We've had some, strategists on, Jay, and sometimes it sounds like try as hard as they might, they can't find a reason not to like the stock market right now. Earnings are growing, the economy's growing. Jay Powell said just this week, right at a media conference, no reason he doesn't think the economy can't keep growing. Fed seems biased towards easing. Is it that simple, you think?
Well, to some degree, I think it is. I mean, the Fed is easing into a rising earnings environment, and I think you've had two pivots over the last few months. Number one, they've decided to prioritize preserving the business cycle versus the inflation fight. And then the second pivot in terms of the financial markets is more of a focus on valuations and multiples as opposed to momentum. I think that's starting to change too. And you've seen that in the last month with the broadening out, where the equal weight, that's the best proxy, looking at the equal weight versus the traditional index. Equal weight did better, for instance, the last month. And I think that could continue into 2025 as it broadens out. To me, it's got a very much of a second half of the 90s feel in terms of, that was the last authentic soft landing, 95, 96 with Greenspan. And I think that's kind of where we are. A lot of innovation, high-tech innovation. Also very important, that burst of productivity growth we had back then, that was major, and that is an authentic silver bullet when you have productivity growth. If you look at the last few quarters, we're ticking up into that 2.5% to 3% range, which after a 10-year period of very lackluster productivity growth, that could make a big difference in terms of profits and profit margins. I do think we're going to be more volatile in this new environment, more 5 to 10% pullbacks, as opposed to, where you have these extended periods where it's kind of quiet. I think we're normalizing. We're normalizing from a nominal GDP standpoint. We're normalizing from a real GDP standpoint. And from an interest rate standpoint, in the late 90s, the 10-year traded above nominal growth. I mean, that used to be a pretty good proxy, nominal GDP in the 10-year. That was a rough estimate, pretty good. The great financial crisis and the aftermath totally shredded that with the zero bound and that hyper activism from the Fed. I mean, I think we're normalizing. We're moving away from that, which is a good thing. You know, we're normalizing. So these higher rates, I think, are going to be here for a while, and they're moving. The good news is they're moving up for the right growth-oriented reasons. When you look at the real rate, it's a growth proxy as opposed to more inflation expected.
Jay, you're known for managing the Tampa Firefighters and Police Officers Pension Fund, which has had remarkably consistent performance. But you guys just came off the best year for that fund, right? The fiscal year ended at the end of September. Did you change anything, or was it just a function of what we have seen in this market environment and the opportunities you're seeing? And do you still see those kinds of opportunities?
I think the financial guide said, well, it's your 50th year, so we're going to make it your best. That's actually what happened. That was our 50th year. And it ended up being, as a sole manager, it ended up being our best. And it just, the stars were aligned. And it's a September 30 fiscal, which also could make it in terms of, as opposed to the calendar. It just, the momentum was there. And we're heavily oriented towards equities.
Right.
And our top holdings really did well.
And NVIDIA is your top holding?
Yes, it's our top holding, and we started on building that position back in 2019, and we have taken more profits than the market value now of the stock, and it's still, so that gives you a flavor of some of the momentum that we've had with some of these holdings. That would be a good example. Right.
And Jay, you talk about how you like, one theme you like, technology companies disguised as industrials.
Right.
What do you mean by that, and what are some examples?
Yeah, you've got these companies that some people might say, wow, that sounds like a stodgy industrial company, like an Eaton, for instance, or a Honeywell.
Or Corning, I heard was on that list, right?
And Corning, which was the backbone of the internet revolution back in the 90s, now seems to be becoming one of the backbones of the AI revolution in terms of the high demand, particularly these data centers for fiber. And the fiber build out continues in a big way. Their springboard plan that was released a couple of months ago is very aggressive in terms of that optical division, fiber division, strong double-digit growth prospects looking out. So I think that's one from a valuation standpoint that also looks very intriguing, not only from a forward multiple standpoint, but very strong free cash flow, strong balance sheet, really good management team with an extremely unique product in that optical segment.
In addition to that, a lot of people like financials right now, and you have a financial among your top holdings, but it's not one of the big banks, it's American Express. Why do you think that they're well poised right now?
Again, a very financially strong company with good momentum. And it's very intriguing to me, this company. The growth prospects are still looking out. They're growing globally and they're growing demographically. They're making really good progress in Japan, which I think is interesting. And another very interesting statistic to me is that new card members over the last year, 60% were millennial and Gen Z. It's got kind of a mystique, the card, for these younger generations, and also globally. So I think it's a very well-managed company with strong momentum and good growth prospects looking out.
Yeah, Jay, it's good to see you. Thanks for coming in.
Thank you.
It's been a while.
Great to be here. Yep.
All right, thanks. Appreciate your time. Coming up, we've got some earnings to get to as shares of Lululemon and Hewlett-Packard Enterprise are in focus following their latest reports. Stick around, we've got more market domination overtime coming up.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains.
We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Fourth quarter results of Hewlett Packard Enterprise hitting the wire just now. Let's take a look at those numbers here. Q4 adjusted EPS 58 cents versus 56 cents. That's a beat. Revenue $8.46 billion versus estimates of $8.26 billion. So beats there on the bottom and top. Looking ahead, it looks like they are calling for Q1 adjusted EPS between 47 and 52 cents. Street was at 48 cents. And it looks like they're looking for Q1 revenue growth. They're calling for up mid-teens %. They also do on that Juniper acquisition, they say they expect that transaction will close in the early part of 2025. So that is within the previously stated time frame. You do have some comments here from CEO Antonio Neri as well. He talks about how HPE delivered an exceptional fourth quarter, record quarterly revenue, talks about capping off a strong 2024. He says we exceeded our full year commitments for revenue, EPS, and free cash flow. He talks about what he calls a differentiated portfolio across hybrid cloud, AI, and networking. And you can see that stock popping about 3%, nearly 4% now. And of course, tomorrow on Yahoo Finance, Julie, we'll be speaking with CEO Antonio Neri, so more insight to come.
Those shares up about 27% this year, so building on those gains. We also just got numbers from Lululemon, so we're looking at those Lululemon numbers as the company's third quarter results hit the wire. Those shares up a quick 7% here. Third quarter earnings per share at $2.87 versus the $2.75 that analysts had been anticipating. Revenue also coming in ahead of estimates. And third quarter total comparable sales, excluding currency effects, so in constant currency, up 3%. That's a little better than estimated. All of that growth, by the way, coming from outside of the U.S. Constant currency international comparable sales up 22%, but in the Americas falling by 2%. And then finally, the company forecasting full year net revenue of $10.45 to $10.49 billion. Analysts looking for $10.42 billion, so ahead of estimates. And the company also authorizing a further $1 billion stock buyback program.
The stock action in this one had been really interesting too, Julie, because heading into this print, it was down about 30% year to date, but it had rebounded strongly. It was up around 30% in just the past 3 months or so. You know, we had spoken on the show about different challenges for the company. There was, over the summer, remember there were the product issues we had discussed, of course, competition as well, but at least initially here, investors like what they see.
Yeah, and I think really interesting in particular what we saw from those China sales specifically. I mentioned international was up 22% in constant currency. China mainland sales up 24% in constant currency. So amidst an environment where we're talking about a lot of weakness in China or deceleration at the very least, this is a company that is still winning in China.
Yeah, investors responding.
Yeah. Well, as those Lululemon shares jump on earnings, let's get some more perspective. Morningstar senior equity analyst David Swartz is joining us now. David, interesting to see these numbers here. What stands out to you?
As you mentioned, the international sales growth was quite strong. Lululemon sales in the U.S. and North America have slowed down, that's clear. But the company still has a lot of potential for growth, both in China and Europe and possibly other parts of Asia too. And right now, Lululemon is opening most of its stores in China, and that investment really seems to be paying off.
David, over the summer, we had talked about some challenges for the company, including challenges relating to product. Are those challenges, are those just all rear view mirror at this point?
Well, we'll see what we hear on the conference call, which is coming up later. These results suggest that Lululemon has overcome some of those problems. I think some of the merchandising issues, though, still remain. The company has done some reorganization of its product development team, and it's going to be some time before some of these new designs and new products get into the stores, probably not potentially until late 2025. I think that we have a lot more to see. But Lululemon still remains a very popular brand. The products are very popular. The market itself of athleisure, I think, is still getting bigger. There's still a lot of reasons to like Lululemon, and a lot of reasons why I think consumers still have a lot of respect for the brand, despite the fact this year the company has had some difficult periods.
And the Americas sales did fall by 2%. In the quarter, revenue for the United States specifically was unchanged. Even if they're growing internationally at the clip that they are, which is pretty impressive, How much of it, this is their home market, it's their biggest market. Is that a problem?
It definitely is a problem because obviously the U.S. and Canada are its biggest markets. But, there have been some tough comparisons this year. Last year, Lululemon had really strong sales of its handbags, which, I think was kind of underappreciated at the time. The Lululemon accessories last year really exploded and they've slowed down this year. And so that's one of the reasons why the comparisons are difficult. But it is clear that there is competition in the US and Canada too that is affecting Lululemon. We've seen some strong competition from brands like Vuori and Alo Yoga. And of course, there's many others like Nike too that compete with Lululemon. And so the competition is there. But I do think that Lululemon is doing a good job of expanding its addressable market. By expanding into footwear, for example. It's still a very small percentage of Lululemon sales, but potentially, it's a very large market because that's a market that really, continues to be dynamic and grow. And Lululemon just has a very small part of it right now. Also, if you look at men's is still only about a quarter of Lululemon sales, but men spend more money on sportswear overall than women do. So, someday I think that percentage could get close to 50-50. Right now, men's is still a minority of their sales, though.
David, I mentioned to Julie how the stock action, this one was interesting. Heading into the print, it was down about 30% this year, but it had really rebounded. It was up about 30% over the last few months. I'm just curious, as a financial analyst, what does valuation look like on this one at this point versus peers?
Well, right now, I think it's overvalued again. My fair value estimate's a little under $300. So there was a time when it was in the low 200s when I thought it was undervalued. This stock tends to be volatile. It clearly kind of went down too far, and now maybe it's going up too far too. But that's not unusual for Lululemon. Typically, for years, I've had this stock as overvalued. To be honest, really earlier this year was one of the few times ever when I had it as undervalued. So this is a stock that people tend to give very high multiples to. And there's a reason for that, of course, because Lululemon has consistently beaten estimates just as it did today. And so people appreciate that and they see it as a strong momentum stock. But I would be a little bit worried about the valuation right now, because as you mentioned, there is a legitimately strong slowdown in its sales in North America that's been happening this year.
What do you think the company needs to do to try to juice that to some extent?
I think that Lululemon's main problem has been that its products have been kind of the same the last couple of years. I still think that people really like the brand and they go to the stores, but when they've gone to the stores this year, they've kind of seen the same stuff that Lululemon's been selling for the last couple of years. As I mentioned, they did have a big hit last year with crossbody bags, and they haven't really come up with anything that big this year to make up for that. And, a lot of the core products like leggings, I think maybe getting a little bit stale. The company tried a new fabric that didn't quite work. People didn't like the designs and they had to pull that out of the stores. And so, some of the products this year, I don't think have been the big hits that Lululemon needs. But I still think that when Lululemon does come out with those products, that the shoppers will be there. I still think the market is there for Lululemon right now.
David, always great to see you and have that instant reaction. We appreciate it.
Thanks.
Time now for what to watch Friday, December 6th. We're going to start off on the jobs front. The monthly jobs report for November is coming out in the morning. Economists forecasting non-farm payrolls to come in at 218,000. It's coming after October only added 12,000 jobs impacted by hurricanes and the Boeing strike. Economists also expecting the unemployment rate to hold steady at 4.1%, while hourly wage growth slows to 0.3%.
Moving over to the Federal Reserve, we'll get a big batch of Fed commentary throughout the day tomorrow, and this will come after comments yesterday from Federal Reserve Chair Jay Powell. He said the strength of the economy gives the Fed the ability to take time on future interest rate cuts.
And we're also going to get a look at the consumer with consumer sentiment data for December coming out in the morning. Economists forecasting that number to tick up to 73.3. The preliminary print giving us more insight into the consumer as the holiday shopping season rolls on.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Markets pulling back from record highs, and even Bitcoin coming off that $100,000 level, despite optimism over the incoming administration's pick for SEC chair. And a key catalyst for investors is, of course, that jobs report. We're going to be looking at the top takeaways from the trading day coming right up. Plus, what will drive the tech trade in 2025? We've got expert predictions and what you need to watch for when it comes to AI and NVIDIA. And the booming business of sports betting. Even Robinhood suggests it might consider joining that field. The CEO of Simplebet joins me straight ahead. Well, the tech sector enjoying gains of nearly 25% so far this year, while the tech-heavy NASDAQ notches a new record close this week as AI continues to be the life of the party for tech performance. We're looking at what may lie ahead with Technalysis Research President and Chief Analyst Bob O'Donnell. Bob, great to see you in studio.
Yeah, it's great to be here. It's always fun to come to New York and come on into the studio here.
So let me ask you, Bob. So let's look ahead.
Yeah.
Going into 2025, and I, of course, I'm hard-pressed to think of a theme investors were more excited about than AI. I'm curious how you think, as we head into this new year, how do you see that technology developing from here?
Yeah, Josh, what we've seen in the past 12 months has been this incredibly rapid transition, and I think that's going to continue and, in fact, accelerate in 2025. And that's actually going to lead to, I think, a lot of different changes. We're going to see things that we think are really big or were really big this past year, maybe not be so big next year, and yet other new things become really big and important. So fundamentally, I think we're going to see, for example, this notion of what I call hybrid AI. The idea that I'm going to do some of my computing, some of my Gen AI stuff in the cloud, but I'm going to do some of it inside a corporate data center, and I'm going to do some of it on a PC or smartphone device. And just the way we saw hybrid cloud computing, hybrid AI, I think starts to change the story when we think about who are going to be the important players, where does some of this computing work get done, who are the software providers, how do they make companies better able to build applications that they in turn can use to change their whole foundation of how they work. Because that's where we are right now. We're just starting to see these big companies start to deploy Gen AI applications. I just finished a survey of about 1,000 US companies, and on average, they're using 6 different Gen AI applications. Now, some of them are POC, but 90% of these companies that I surveyed were already using one Gen AI app in production already. Next year, we're just going to see that grow. And alongside that, we're going to see the big cloud guys. I just came from AWS reInvent in Vegas. They made a whole bunch of announcements. I was just at Microsoft Ignite 2 weeks before that. They, of course, had a whole bunch of stuff around Azure and Gen AI. Google's got things going on as well. So we've got a lot of big players, a lot of big parts moving. Obviously, OpenAI continues to be a lead on the foundation model side, but where that Gen AI work is happening, again, I think is going to evolve, and there are some important implications there. Other thing is silicon. We're going to see more and more custom silicon. Of course, NVIDIA is going to continue, I think, to dominate, to be clear, and we'll get to more of that later. But, we just saw Amazon introduced a new chip called Trainium 2 that they believe could be a competitor, a lower cost competitor to NVIDIA. Doesn't mean they're not going to continue to use NVIDIA. Of course they are, but it's an option. Microsoft has been doing the same thing, same with Google. So we're seeing a lot more diversity in terms of the silicon that's being used to power this stuff. We're seeing a lot more software. And back to NVIDIA, just to follow up on that point,
because I name that clearly, investors decide,
Yes.
listen, that is the face of this AI revolution, right? It's Jensen Huang and his team had an incredible year. What do you see? How does NVIDIA's business, I guess, evolve from here next year?
So, first of all, they're going to continue to crank out GPUs in as fast as they possibly can, and the orders are going to be as big as they can possibly be, because we're still building up the capacity that people need. Now, there will come a point, it's not going to be in 2025, maybe it's 26, 27, when as the way some of this stuff gets calculated and performed, maybe we shift to see where some of these things are done, and some of that starts to moderate. But we're still a little bit of ways away from there. But I think the important thing to think about with NVIDIA is the software story. So what they have been doing, they have these NIMs and other software tools that they've been developing and making available. So for a number of the companies like your HPEs, your Dells, your Lenovos, your Ciscos, the companies that sell servers to enterprises and businesses, they're saying, yeah, you can have our GPUs, and oh, by the way, just make sure you bundle our software with it, from which they can start making licensing money. And so I think you're going to start to see a software licensing business start to come into NVIDIA as well. And initially it's going to be small, but still that gives them a nice growth opportunity. And also, if we would ever see a slowdown, again, a couple years out, it shields them a little bit from that because all of a sudden they'll have software revenues as well. So I think, Jensen's a very smart guy. He's going to be playing a lot of different cards in that regard. And of course, related to that, another trend next year is AI PCs and
AI-enabled PCs. Do you think AI-enabled PCs sort of jumpstarts a meaningful refresh cycle? Is that a 25 event, 26 event?
It's a 25 and into 26 event. And just to finish the NVIDIA story, rumors and rumblings are they may be jumping into this space as well sometime next year. So that's yet another angle on NVIDIA. But yes, I do think we're going to see, because you've got several things. When I talked with you last time about happening in the PC market, you've got the Windows 11 refresh, you've got the Windows 10 end of support, you've got all these AI PCs coming out there. You've got silicon from all the major players. And a lot of companies are sitting on 4-plus-year-old PCs that they updated at the beginning of the pandemic. It's time for a refresh anyway. So I think that's another story to watch in 2025.
It's a lot of tailwinds. Bob, we'll have you back next year. Talk about 26 as well.
Sounds good.
Thank you, sir. Great to see you.
Yeah, you too. Thanks.
Meanwhile, the Dow leads losses as the stock rally hits pause. Bitcoin pulls back from 100,000. Here with the trading day takeaways is Yahoo Finance's Josh Schaefer. Josh.
Hey, Josh. Yeah, so the three major indexes closing a little bit lower today, but coming off record highs. Not necessarily a ton of interesting action we were watching from that perspective. What stuck out to me today, of course, Bitcoin crossing 100,000 for the first time Wednesday night, actually inching up to hit 103,000 during the trading session today, Josh. One thing that's been interesting with Bitcoin too, when we just take a look, I'll go 1 month. A lot of the big moves have actually happened overnight. So when you go even shorter here, you can see the large move really coming in those overseas sessions, which has been an interesting thing to watch. A lot of times people are just waking up and your crypto has moved a lot when it's a 24-hour session. But what I was taking a look at today, Josh, was the moves in other cryptocurrencies. So I'll show you on the board here over the last month. So the election was a month ago today, right? We're going to equal weight this out. Let's find Bitcoin. 43,000 here. Look at the amount of altcoins that have outperformed Bitcoin. So I asked our guest Andy Baer from CoinDesk earlier today about this, and he explained basically Bitcoin already has ETFs, right? A lot of these other coins would benefit from a more pro-crypto regulatory framework. Maybe they could get an ETF attached to their coin. They need Web3 platforms that are going to be able to be legalized, things like that. And when you take a look, Josh, I made this into a chart for us too, so you can really see it. Bitcoin is down here over the last month. Look at how small those gains look. Bitcoin's up 50%. But when you look at these other three coins, we're looking at Cardano. I put in Dogecoin here to show that it's just kind of risk on. But you've seen these massive, massive rallies. The other thing Bear said though, if you just want a little bit of crypto exposure, Bitcoin's probably your place to be. This is volatile, and it's a little bit too hard to track on a day-to-day basis.
We spoke to Michael Saylor today, so we heard from the mountaintop. He was on the show. He told us he expects Bitcoin will be the most valuable thing in the world 100 years from now, Josh. So buy it for the grandkids.
Hey,
that's what he's saying.
Bitcoin market cap over $2 trillion, Josh. There aren't many U.S. equities that have a larger market cap than Bitcoin, and it is quickly chasing some of those big names, right? So that's going to be an interesting thing to watch.
All right, Schaefer, bullet point number 2.
All eyes are on the labor market, right? So we kind of had a quiet day in stocks today, and I think part of that is because we have that big jobs report tomorrow. When you consider sort of key catalysts here in December, you really have this jobs report, you have an inflation print next week, and then you have the Fed meeting the week after. Other than that, it feels like stocks are a little bit just kind of drifting higher here, headed into December, or at the end of December. So here's what we're looking at for this November jobs report. About 220,000 payrolls expected to be added. That number's been shifting throughout the day, been at 215, 220. Unemployment rate expected to be flat at 4.1. The major narrative here, Josh, being we had that weak October print because of the hurricanes, because of the worker strikes. Remember, that number was 12,000 last month. So you're supposed to see a big uptick, unemployment flat. The economics team over at Bank of America says if we get this, probably doesn't mean much for the Fed in December. It's probably going to be a little bit of a snoozer of a report. A lot more concern about that inflation print, though, next week.
Yeah, because the narrative certainly has been labor market cooling, not crashing.
Cooling, not crashing, and this is more cooling, not crashing. So as long as there's not a big surprise, could be fine.
We shall see, Joshua.
We will.
All right, thank you, sir. Stick around. More Ask You for a Trend right on the other side. Social media platform Blue Sky has surged since Donald Trump's election victory. The company offers a decentralized platform, which means it's not bound by a single authority. But can Blue Sky succeed where others have not? Akiko Fujita joins us now. So Akiko, can it?
Well, that's a big question, right? The idea of decentralization in many ways rooted in the early days of the internet, where you had a network of machines connected organically. Flash forward to today, and you've got companies like Meta and TikTok and X dictating their algorithms and your feeds. Blue Sky's trying to disrupt that by giving users direct control over what they see. A key factor here, Blue Sky is an open platform, which means the data that drives the feeds is available to the public. There's another critical difference here. Blue Sky is built on something called an AT protocol. COO Rose Wong tells me that means users own their data and can take it with them.
The idea is you can put Reddit, Facebook, dating apps, Goodreads, anything on top of our protocol. Why do you want to do that? Because then you're your identity, your data can actually move from platform to platform, and you're not locked into these walled gardens, and you own your identity on Blue Sky versus having the platforms own your identity. And so the vision is actually much larger.
The catch is you need other tech firms to sign on to this to be able to move seamlessly from one platform to the other. That hasn't happened yet, but the hope is Blue Sky's success will spur them to at least consider shaking up the infrastructure, Josh.
And Okiko, what are the chances for that success? I mean, despite other social media platforms emerging, dominant players have remained the same for years, right?
Yeah, I mean, we have seen other platforms experience a spike in their user base off of big events. You had right-wing platforms like Parler and Gab emerge as an alternative to Twitter under Jack Dorsey. The migration to Mastodon happened after Elon Musk bought the platform. And then you had the president-elect himself, Donald Trump, establishing Truth Social after his 2020 loss. Now, while it did make some gains post-election, Truth Social's total number of users trails by 400 times that of X, as well as Meta's Threads, according to Bloomberg. Downloads for Blue Sky have also slowed down from the highs that we saw post-election, but Wong tells me she thinks Blue Sky can thrive precisely because the social media landscape is so fragmented now. It's no longer about the global town square.
I think that binary choices are often wrong. Like, is it communities or global square? And I think this is where we take a page out of the offline world, which is like, how do we interact as people in communities? And I think that we have many circles, or in some ways like concentric circles, in which we have, you know, a smaller group of people that we're close with, and then there are larger groups. And so I think that's should be mirrored online, where you should have small world, big world experiences.
Josh, regulation is also part of the conversation here on why these upstarts haven't been able to challenge the big social media companies. It's largely because they have such a hold on these platforms. But you heard Rose Wong there. It does feel like increasingly you've got users sort of going into their cozy corners, if you will, as opposed to sort of Twitter's heyday, maybe 2011 or so, when it was about one platform and the big conversation that happened there. All
right, Akiko, thank you. Appreciate it. On Wednesday, DraftKings is completing its acquisition of Simplebet, a provider of automated in-game wager pricing. The deal will allow DraftKings to integrate Simplebet's machine learning models and improve the quality and speed of data throughout the DraftKings platforms. And joining us now is Chris Bevilacqua, Simplebet CEO. Chris, great to see you and have you here.
Yeah, great. Thanks for having me.
For the uninitiated, Chris, who are listening right now, explain Simplebet. It's micro betting. What does that mean, and what are some examples?
So Simplebet, we're an enterprise software data and technology company, right, that has built this enabling technology, this software technology that we license to third parties like DraftKings and other sportsbook operators. And really what micro betting means is, think of it as micro time frames. So we create opportunities to bet on every pitch and every at-bat in a baseball game in real time, or every play or every drive in a football game in real time, or every
So I'm like watching baseball. I can bet on whether it's going to be a ball or a strike?
Ball or a strike, or is the pitch going to be over 95.5 miles an hour, yes or no? And so we basically take a 3-hour baseball game, we turn it into thousands of mini betting opportunities.
And Chris, you helped create this company. You worked at it for years. Why did you decide, listen, now's the time to sell to DraftKings?
You know, that's a great question because
I would imagine, Chris, the space you're in has got to be hot and growing fast.
Yeah, there's no question, and that's one of the benefits of now being with DraftKings, which is, you know, basically a part of a duopoly now between them and FanDuel that control over 80% of the online sports betting market, and the whole market now moving towards in-play betting, which is what happens, bets that happen while a game is going on. And that's really where the whole market is moving, and that's where micro time frame and micro betting is really at its finest. And our technology enables that. But the problem that we had two major headwinds, right? The first was getting access to high quality live data streams. So we had data companies like Radar and Genius that were in the way of us and the league IP. So there was always friction in getting the necessary data from the data companies. That's issue number one. The bigger issue was over time, and what certainly played out over the last number of months, and actually last year or two, is our customers were becoming our competitors because they wanted to in-house the technology that we have. In other words, they wanted to build it themselves. So those two factors, really, I think, drove our decision. If we're going to really unlock the value of our investment over the next couple of years, we have to do it inside of one of the big operators. And DraftKings, because they were one of our early clients, and we've had a great relationship with them. They were the right partner at the right time.
And how does DraftKings, now that they acquire Simplebet, Chris, how does it fundamentally help grow their business, attract new users, new fans?
Yeah, so as I said a minute ago, like the market is moving towards more in-play offerings, right? So right now in the US, in-play makes up somewhere around 35 to 40% of all of online sports betting handle. Whereas over in more mature markets, like over in Europe and Asia, it's closer to 70%. So you have this movement occurring that clearly is moving towards in-play betting. And in order for DraftKings to continue to grow and grow in an outsized way versus their competitors, they want to win the in-play market. And our technology, we're years ahead of anybody else. And so by them having that as captive technology, in other words, taking basically moving out of the B2B business, right? Because we have contracts that are going to expire. And then now they're going to have a product that is years ahead of anybody else and is now going to be captive to them. And you get more casual gamers, right? That's why, like right now they got about 3.5 million active users. And that is growing. And this type of betting is more attractive to casual users.
Are there certain sports, Chris, where micro betting is more popular or even just makes more sense than others?
Yeah, I think for us, we've certainly had the most success with baseball, right? Because baseball, you got 75, 80 at-bats in a game. You've got 300 pitches or so in a game. And we have dozens of markets around all this. You have thousands of opportunities, right? So the cadence of baseball is like perfect for micro betting.
Right.
But it's really good in NFL and college football and NBA and college basketball. That's where we're getting 95% of all the handle across sports betting is in those 5 sports.
I would also think, Chris, that, listen, if I was a league, if I was the NFL, or if I was a team, I want viewers watching as much as possible. It feels like micro betting, because it's just so fast and so robust and so constant, would be one way to do that.
There's no question. There is no, and I come from the media business, right? I wasn't a sports betting guy when I started the company 6.5 years ago. So I always knew, right, and most people would intuitively understand that if you bet on a game, you're going to watch and engage with that game longer, right? So you watch what's happening in media and you see ratings going down across the board, cutting the cord, and we have this whole movement of what used to be mass media and traditional media into personalization and personalized media, direct to consumer. And in the middle of all that is technology, and sports betting is right at that crossroads. And so what we're seeing now is all genres of programming are being less engaged and less watched inside of the traditional media. NFL and college football, as an example, are actually going up. It's in many ways defying gravity. But to me, there's no surprise that that's happening, because now betting, which was illegal 6.5 years ago, is now in 38 jurisdictions. It's in the majority of the United States. That level of engagement, and people that have money and bet on games, is just driving live video consumption. And it's an amazing combination for the media business.
Keep those eyeballs hard. Chris, great to see you. Appreciate your time.
Thanks for having me.
On the latest episode of the Yahoo Finance Sports Report, host Joe Pompliano breaks down the big ratings that the NFL produced on Thanksgiving Day. Be sure to scan the QR code below to stay up to date with all the Yahoo Finance podcasts, and check out the Sports Report every Thursday at 5 p.m. Here's a look at this week's episode.
This year's game was a little bit unique because it was 2 of the worst starting quarterbacks in the league today. Both backup quarterbacks for the Giants and Cowboys, with Drew Lock and Cooper Rush, played, and the game wasn't very exciting. Still, it averaged 38.5 million viewers, which will likely make it the most watched regular season game this NFL season, and the 4th most watched Thanksgiving Day game ever. And not to be outdone, even the Miami Dolphins and Green Bay Packers put up a huge number at $26.6 million in the late night game. Now, we don't have the final number from the Lions game earlier in the day since CBS ended its contract with Nielsen this past October, but I'm sure that'll be just as big given the Lions have become a mainstay on Thanksgiving Day for the NFL.
For a chart of the day, we're looking at the cycles of Bitcoin, and Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yes, and this chart coming to us courtesy of Gautam Chagani over at Bernstein, who has a price target of $200,000 on Bitcoin for the end of next year. Now, conventional wisdom goes that Bitcoin moves in 4-year cycles, and Chagani divides them into 4 periods within each of those 4-year time spans. He says there's a breakout period out of a period of sort of low volatility, a humdrum market. Something usually happens to cause it to break out into that period. A couple of examples: Tesla buying Bitcoin in the past, he says, the growth of Grayscale assets in 2020, of course, the spot Bitcoin ETFs. Then he says there is a hype period where there's a lot of money pouring into the market and a lot of people start talking about it. I guess this is the period where taxi drivers are talking about it, et cetera. Then he says you see a drawdown phase, a correction phase, where people are booking profits, and you see big drawdowns in the past on a percentage basis, as much as 80%. And then finally, an accumulation phase. He calls this the year of healing. So you see the 4-year periods that we have seen in the past with each of those phases. Notice we're only a couple years into this phase right now, which is why he still thinks there is room to go. We've only seen the breakout, and we're currently in the hype period, according to him. Now, as to whether and what the correction period is going to look like this time around, we earlier, of course, talked to Michael Saylor, the executive chairman of MicroStrategy, and this is what he said about these cycles.
I think what you'll see is you will still see volatility, but you won't see the extreme drawdowns of the last cycle. You'll see a more gentle volatility. It'll surge up, it'll come back, but I don't expect like we saw an 80% drawdown in the depth of the crypto winter from 66,000 to 16,000.
And he doesn't think that's something that we will necessarily see again. Likewise, when we talked to Skybridge's Anthony Scaramucci in the last hour, he too said you're going to see the volatility, he said. But at the same time, he thinks there's more of a floor under Bitcoin than there has in the past. So again, that suggests that maybe those sort of big, sharp drawdowns we've seen in these correction phases, they're not going to be as sharp going forward. Of course, as Scaramucci also said, he's been humbled many times in life and in markets. So it's difficult to be sure of anything, but this is something they're looking for potentially, that the next correction will not be as severe. Josh?
All right, thank you, Julie. Let's take a look now at what's trending after hours, starting with Petco, and those shares are surging in extended trading. And the pet wellness company reporting a beat on Q3 results, including a narrower loss per share than expected. Chain posting revenue of $1.51 billion in the quarter, sees revenue of $1.55 billion for Q4. Shares of DocuSign skyrocketing after hours. The company's third quarter results beating analyst expectations. Adjusted earnings per share coming in at 90 cents versus estimates of 87 cents. DocuSign's revenue forecast for Q4 also coming in higher than expected, and that's helping lift that stock. And Ulta Beauty shares surging after reporting a beat on earnings for the third quarter. And the big surprise, comparable sales unexpectedly edging higher in the period. Ulta Beauty also lifting the low end of its sales outlook for the full year. CEO Dave Kimball saying the company remains confident that its model and strategies will drive long-term profitable growth. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.